Corporate governance, the system by which business corporations are directed and controlled. The corporate governance structure specifies the distribution of rights and responsibilities among different participants in the corporation and spells out the rules and procedures for making decisions on a corporate affair. By doing this, it also provides the structure through which the company objectives are set and the means of attaining those objectives and monitoring performance. Those charged with governance, TCWZ, are the individual with responsibility for overseeing the strategic direction of the entity, an obligation relating to the accountability of the entity, including overseeing the financial reporting process. First, what is corporate governance really? Think of it as, think of a company like a kingdom. Okay, shareholder is the owner of a company, or we can say owner of a kingdom. They invested money. The ministers, management are the ministers running day-to-day affairs. And board of directors, the wise council making sure minister don't mess things up. So corporate governance is the system that ensures the company or kingdom is running properly, ethically, and in owner's best interest. And according to ISA 260, management is people responsible for running business operation. Okay, stakeholders. If you don't understand stakeholder, you don't understand governance. So let's simplify it. Okay, shareholders is a shareholders relationship is the owners. A relationship with the company, it is the owners. So their needs is profit, that is dividend or increase in share value, growth in share value. Okay, bank relationships, it is lender of a company. Their needs are their loan need to be repaid, loan repayment and interest also should be paid on time. And employees and management, the relationship of employees is to provide service or work, need salary, job security and benefit. Supplier relationship, provide goods or services, need timely payment. Government want taxes. Other companies cross holdings want influences and stability. So what is the objective of corporate governance? It is not about making money, it is about making money properly and sustainably. The main goal is increasing the long-term shareholder value. How to increase that is by ethical behavior, no cheating, transparency, not hiding anything, any documents, any information. Accountability, someone must be responsible. The person who had done the work should be responsible for their work. Legal compliances, they should follow rules, regulations, laws. Okay, what does governance actually do? Think of it as an oversight magic. Okay, strategic decision, where the company is going, uh, hiring top employees, deciding their salaries, managing risks, ensuring laws are followed, monitoring auditors. Why is corporate governance important? Because when it fails, disaster will happen. Examples: Enron, Lehman Brothers, Royal Bank of Scotland. These companies collapsed due to fraud, poor decision, weak control systems. So the conclusion is strong governance is equals to long-term success. Weak governance is equals to collapse and losses. OECD principles, global standard from Organization for Economic Cooperation and Development. Think of these as a global rule for behavior, good behavior. Key principle, effective framework, proper law, clear responsibilities. There should be proper law and clear responsibilities. There should be segregation of duties and responsibility, so that all the authorities, all the departments should know about their should be clear about their responsibilities. Okay, in the right of shareholders, shareholder must be able to vote, get information, receive profits, get timely information, and there should not be mm, any money laundering and things. And insider trading also should not be there. Okay, and equal treatment. There should not be any favoritism. Protect minority shareholders. Role of stakeholders. Respect employees, suppliers, etc. Allow whistleblowing. Okay. Um, Transparency and disclosure. Honest financial reporting. External audit required. What is the board responsibilities? Company guiding the company, monitoring the management, be accountable. UK Corporate Governance Code from Financial Reporting Council. Okay, comply or explain. UK Corporate Governance Code. You either follow the rules or you explain very clearly why you didn't follow the rule. It ensures flexibility and transparency. Main principle of UK code is um, board leadership. Board drives long-term success. It sets strategy, values, cultures. Must manage risk. Must manage stakeholders. Division of responsibility. The chairman and CEO should not be same person. It should not be allowed to be the same person. They should be separate. There should be separate chairman. There should be separate CEO. Why? Because to avoid too much power in one person. Chairman's rules. Chair, Chairman's rules leads board, ensures effectiveness, encourages discussion. Board structure. It is the mix of executive directors and non-executive directors. Non-executive directors challenge management, provide independent judgment. Summary. Corporate governance ensures companies are run ethically, transparently, and in shareholders' best interest through proper oversight by board, protection of stakeholders' rights, strong internal controls, compliance with frameworks like OECD, UK Code. Weak governance lead to failure. Strong governance lead to sustainable success. So board support. Company secretary. The board cannot function alone. It is supported by the company secretary. Think of them as the chief compliance wizard. Their role ensures law and regulations are followed. Help board with policies, procedures, information, time management, resources. Without this support, board become inefficient and non-compliant. Divisions of responsibility. Um, okay. Divisions of responsibilities, good governance practices, clear structure. Board roles are documented. It is very important because it avoids the confusion. Separation of roles, CEO and chairmen are different, prevents too much power. Majority non-executive directors. Okay. Strong independence. Independence issue. Person. Why a person could not be an independent? Why independent is if he has long tenure. Okay, if person is working till now since 1989, then we can't say that person is independent. Okay, it's like we will have a doubt that person is not independent, and let's say it is uh, linked to major shareholders. So according to UK code, long service plus shareholder connection is equals to independence compromised, but it is still allowed because that person brings, because if yes, if he brings experience and add values, so independence is preferred, but competence still matters. Composition, succession, and evaluation. This is about building and maintaining a strong board over time. Board appointment must be formal, transparent, and based on merit. There should not be any favoritism. Nomination committee, mostly independent non-executive directors, ensures unbiased hiring. Re-election, the director must be re-elected or reviewed every year. Why? Because it keeps them accountable. And chairman limit, maximum tenure is 9 years. Why? Prevent dominance and loss of independence. Okay, diversity. Board should include gender diversity, social diversity, ethnic diversity, not just ethnic. It is better decision making. Evaluation. Every year, board performance reviewed. Every year, board performance should be reviewed. Individual directors should be assessed. So, key question is: are their work still useful? Are you still useful? Is the board still useful? Is the directors still useful? Okay, example. What company can do right? Like they can use external consultants. Focus on skill plus diversity. Regularly review board composition. They can plan future appointments. So we can say that good board is not static. It evolves as per the circumstances, as per the environment. Good board evolves, and their values, their decisions, their policies also evolves. Okay, can evolve. Audit risk and internal control. Board responsibilities ensures audit independence. Internal or external auditor must be unbiased. Financial integrity. Financial statement must be accurate, honest, and reliable. Fair reporting. Report must be fair, balanced, and understandable. Risk management. Uh, Identify risk, control risks, decide risk appetite. Audit committee. They are made up of independent non-executive directors. Okay. So what do audit committee do? Audit committee reviews the financial statement, take accounting policies, judgment, estimates, ensure that there is transparency, compliance, confirms that internal controls are working. Okay, insights. If financial reporting lies, the entire system collapses. Remuneration. Remuneration committee. Okay, this is remuneration committee. Goals is pay directors in a way that supports long-term success and company strategy. This is linked to performance. There is no reward for failure. Independent committee, only non-executive directors decide to pay. No director can decide for themselves. Can decide their own salary. No director can do that. Okay, and there would arise the question that who will decide the salary remuneration for the NED who are employed in remuneration committee. That will be decided by chairman. Okay. Good practices: shareholder approvals, long-term incentives, no bonus during poor performance, alignment with workforce. If rewards are wrong, behavior becomes wrong. Corporate governance failure. Even with rule, companies still fail. What could go wrong? Poor decision making. High debts are ignored. Weak board decision. Key failure did not fix financial problem early. Audit failure. Audit committee didn't question accounting. Delayed goodwill write down. Okay. And example 2, issues. Auditor is maybe accused of ignoring warning signs, lack of independence, close relationship with client. So what we should like keep in mind that if auditor becomes too friendly, becomes friendly with the client, then their independence will be questioned, and we can think that they stop being useful for the shareholder. Let's say that. Role of auditor. Auditor must be independent, must be skeptical, use professional judgment. They are key to governance. So common governance deficiencies. You must identify these in scenarios. Lack of independence, too many executive directors, long tenure. Poor disclosure, not explaining non-compliance. Weak succession planning, no future leadership plan. Poor diversity, similar background. Ineffective internal control, no proper risk system. Bad remuneration practice, high pay despite poor performance. Comply or explain problem. From Financial Reporting Council issue. Should say companies say they comply but don't explain properly. Use vague statement. Bad reporting. It is a bad reporting. Okay. Other problems: poor diversity reporting, weak link between strategy and remuneration, no explanation of internal control reviews. Corporate governance ensures companies are directed, controlled properly through strong board structure, independent oversight, effective audit and risk system, fair remuneration and transparency. Failures will arise when independence is compromised, risks are ignored, auditors lack skepticism, and board fails to act responsibly. Why audit committee exists? The board cannot personally check every financial details, so it creates a specialized independent group to do it properly. That group is called audit committee. Purpose say to create formal and transparent arrangement for financial reporting, risk management, internal control. Mandatory for listed companies. Best practice for all companies. Okay, composition of audit committees are very testable. Okay, um, they are very testable. So composition, it should be at least 3 independent non-executive directors, and for a small company, two independent non-executive directors. So financial expertise. At least one member must have recent and relevant financial expertise. Example, um, collective competence. Entire committee must understand the industry or sector. Okay, Uh, entire committee entire committee must understand the industry and the sector. You cannot the insight is you cannot supervise what you don't understand. Okay, very important principle is the external audit report to shareholder, not management. Why? Because it prevents manipulation, ensure independence. Audit committee role: act as a bridge between auditor and shareholder. Bring auditor independence, strengthens internal audit independence. Okay, what does the audit committee focus on? It's just accounting. It considers financial reporting risk, internal controls, tax issues, legal matters, environmental risk, anything that affects financial statement. So let's, for example, like role oversee financial. A role of audit committee is like they oversee financial reporting integrity, risk management, internal control, internal and external audit. Okay, they it's their work. They should audit committees should oversee this. Okay, responsibilities are written clearly. Composition meet requirements. Financial expert present, chaired by chartered accountant. Strong governance. Okay, our guidance from Financial Reporting Council. Of all committee, the audit committee is most crucial. Why? Because it protects the truth in financial reporting. The rules and responsibility. Okay. Monitor financial statement. Check accuracy, completeness, judgment. Example: are estimates reasonable? Are there any manipulation? Ensures ensure report is fair, balanced, and understandable. Report must reflect reality. Report must be clear, not misleading. Review internal control and risk systems. Check Are controls working? Are risks identified? Exceptions: if there is separate risk committee or boards handle it. Okay, and monitor internal audit. Check its effectiveness. If there is no internal audit, then it must review annually, recommend whether needed or not. External auditor appointment recommendation. It should recommend the appointment, reappointment, removal. Final approval is equals to is done by shareholder. Auditor independence and effectiveness. Ensure that the audit committee also ensures auditor independence and effectiveness, which help to ensure that there is no any bias, proper audit quality is maintained, and non-audit service policy. Control what extra services auditor can provide. That also audit committee oversees. Key rule: only trivial services should be pre-approved. Why? Too many service. If there is too many, if the audit external auditor is giving too many services, then there will be independence risk. Okay. Whistleblowing. It is very important. Audit committee must ensure employees can report issues confidentially. Proper investigation follow-up inside. So if employees are afraid to speak internally, they will go public, and that is far worse. Report to the board. Audit committee must explain what it has done. So board they have to report that what they have done. Protect shareholders. Ensure financial reporting is reliable and controls are effective. So final summary is audit committee composed composed only of independent non-executive directors. Okay. Ensures the integrity of financial reporting, oversees risk and internal controls, maintains auditors' independence, monitors audit functions, and protect shareholder interests through transparency and accountability. So we can check that if there is any scenario question, then we can check that if there is no any financial expert, there is a deficiency. If there is too few independent non-executive directors, there is deficiency. If auditor is too close to management, there is deficiency. If there is no any whistleblowing system, there will be deficiency. And if there is no review of internal audit, that is also a hint of deficiency, or let's say that is also a deficiency. Okay. Clarity of audit committee reporting. If reporting is unclear, then even good governance look bad. So what this means, audit committee report must be clear, transparent, specific. It should not be vague. Why is this important? Investors rely on these reports to trust financial statement, understand the risk, decide whether to invest. Be prepared to meet investors. Audit committee members should be able to explain decisions, justify judgment, answer difficult questions. This shows confidence, accountability, benefit of audit committee. This is why they exist. They just list, understand. Don't just list, understand. Okay. And improve confidence, build trust among investors, public stakeholders, ensures high quality financial reporting. Independent oversight, effective audit committee investigate issues on their own initiative. Do not wait for CEO instruction. This is critical independence. Also, demand the necessary information. Ask difficult question. If you don't ask question, you are not governing. You are just observing. Reduces fraud risk. Act as deterrent. Makes fraud harder to hide. Strong monitoring, fewer chance of manipulation. Detailed review of audit matters. Board delegates complex audit work. Audit committees handle it deeply. Improves quality and efficiency. Okay. Independent judgment. Non-executive director contributes experience, and objectivity used in risk analysis, investment decision. Link with auditors, direct communication with internal auditors and external auditors. It removes the management interference. Limitation of audit committee. Even the best system fails if people don't respect them. If they are seen as burden, some board think we don't need this. This leads to poor implementation, weak governance, time and expertise pressure. NED must Non-executive directors must attend meetings on understand complex issues. So it is hard to find qualified people. And high risk, low reward, heavy responsibility, legal and reputational risk. But some avoid these rules. That's why some avoid these rules. Cost. Audit committee requires skilled people, time, resources. So the audit committee must justify the benefits as well. Okay. Depends on board support. Biggest limitation is if board ignores them, no access to information. So audit committee becomes useless inside. An audit committee is powerful only if it is respected, informed, and independent. Okay. Risk management and internal control. Okay, this is core governance. So who is responsible? Board. Ultimate responsibility is with board. Oversees entire risk management and internal control system. They should review at least annually. So audit committee should review internal control risk system unless handled by separate risk committee. Management implements control daily. The board designs the system, management runs it. What is risk appetite? Explanation: how much risk is the company willing to take to achieve its goal? It is set by board. Culture. Um, Good risk management depend on ethical behavior, awareness, responsibility. How to build it? Training, communication. Rule don't control behavior, culture does. Controls are a system to prevent internal control. Seventh number, internal control. Controls are system to prevent errors, detect fraud, ensure accuracy. Types of controls: financial, operational, compliance, strategic. Board must decide what is a significant control failure. Eight components of RMIC system. You must remember this structure. Okay. Assessment, risk assessment. Identify risk. Risk management or mitigation. Reduce or control risk. Information and communication. Share relevant information. Monitoring and review. Check if systems work. Shortcut is identify, control, communicate, review. Types of risk: financial risk, cash issues, operational risk, system failure, reputational risk, bad publicity, behavioral risk, fraud and ethics. External market regulation, third parties, suppliers, partners. Important: some risk cannot be controlled directly, must be managed. So final summary is audit committee strengthen the governance by improving financial reporting quality, ensuring independent oversight, reducing fraud risk, and linking auditor with the board. However, their effectiveness depends on independence, expertise, and board support. Risk management and internal control system overseen by the board and supported by audit committee are essential for identifying, managing, and monitoring monitoring risk in line with the company's risk appetite and culture. If you see a scenario, then check. Weak audit committee's governance issue. If there is no risk review, then RMIC failure. Poor reporting, transparency issue. No culture, high risk of fraud. So, corporate governance committee. Company creates special committees of the board to improve control and oversight. These committees are mainly made of non-executive directors, audit committee um, to ensure non-executive directors mainly made of. So in summary, we can say that what are the corporate governance committees? Okay, these committees are mainly made of non-executive directors. Audit committee. Purpose is financial reporting and audit process are reliable. Key responsibilities financial reporting, review financial statement, ensure they are true and fair, clear and understandable. Internal control and risk, monitoring internal control system, review risk management. External audit, recommend appointment, removal of auditors. Review auditor independence, discuss audit findings. Internal audit, monitor effectiveness of internal audit, ensure proper functioning. Communication act as link between board and auditor. So the keyword is independence, oversight, financial reporting, internal audit, internal control. Composition at least 3 independent non-executive directors. There should not be any executive directors. Okay. And remuneration committee decide how much directors and senior management are paid. Its purpose is this. Responsibilities, it sets salary, bonus, incentives, link pay to performance, ensure fairness. Important rule, director cannot decide their own pay. Why is it important? Excessive salaries, it prevents excessive salaries, misuse of company fund. Composition is only independent non-executive directors. Nomination committee to handle the appointment of directors. Responsibilities, identify suitable candidate, ensure skill, expertise, diversity, plan succession, replacement planning. Why is it important? Ensures strong leadership, right people in right roles, composition, majority independent non-executive directors. Risk committee sometimes separate. Sometimes it is separate. Purpose to manage and monitor committee risk. Responsibilities, identify risk, assess risk, monitoring risk. Sometimes this role is done by audit committee or it could be done by board also. So easy comparison table is there is committee, 4 committees. Main focus is audit committee focus on financial reporting and audit. Remuneration committee focus on pay and incentives. Nomination committee focus on hiring directors. Risk committee focus on risk management. So why are this committee needed? They improve independence, they reduces bias, increases transparency, strengthen corporate governance. So when we are asked explain audit committee, we can say we can write definition, composition, independent no, 3 independent non-executive directors. Responsibilities is financial reporting, audit and control. Importance. Likewise, for other committees also we can give the definition, composition, responsibilities, and importance. Okay, the memory trick ARNR. Um, if the memory trick the is A for audit, R for ARNR, A for audit, R for remuneration, and for nomination committee, R for risk committee.